If you're a complete beginner and the word investing makes you think of charts, risk, and losing all your money overnight, don't worry, because in this video, I'm going to show you exactly how to start investing from scratch, even if you have no experience, no background in finance, and only a small amount of money to begin with. The truth is, most people delay investing because they think they need to be rich first. They assume they need thousands of dollars, special knowledge, or some secret strategy that only experts know about. But in reality, the hardest part of investing isn't making money, it's simply getting started. So let's make this as simple as possible. Before you invest a single dollar, you need to make sure your financial foundation is solid. That means three things. First, you should have a basic emergency fund. Second, you should pay attention to high interest debt, especially credit card balances. And third, you need to invest money you won't need tomorrow. Investing works best when you give it time. Now, if you've got all that covered, the next step is understanding what investing actually is. At its core, investing means putting your money into assets that have the potential to grow over time. Instead of letting your money sit in cash and slowly lose value because of inflation, you're putting it to work. For most beginners, the easiest and safest place to start is with the stock market, but not by picking random companies. That's where a lot of people go wrong. They watch a few videos, hear about a hot stock, throw money at it, and then panic the second it drops 15%. That's not investing. That's gambling with a better haircut. Real beginner investing should be boring, simple, and repeatable. That's why broad index funds and ETFs are usually the best option for most people. An index fund is basically a collection of many companies bundled into one investment. Instead of betting on one stock, you're buying a small piece of hundreds, scores, or even thousands of companies at once. For example, if you invest in an S&P 500 index fund, you're getting exposure to 500 of the largest companies in the United States. So instead of trying to guess whether one company will win, you're betting on the long-term growth of the overall market. That's a much smarter game. Now let's talk about how to actually start. Step 1, choose an investing account. If you're in the US, this could be a Roth IRA, a traditional IRA, or a regular taxable brokerage account. If you're outside the US, you'll want the equivalent account available in your country. The point is simple. Open a low-cost investment account with a reputable brokerage. Step 2, deposit money consistently, not once. Not only when you feel like it, consistency matters more than intensity. If you can only invest $50 a month, that's fine. If you can do $200 a month, even better. The amount matters, but the habit matters more. Step 3, choose simple investments. If you're a beginner, one broad market ETF is often enough to start. Something that tracks the S&P 500 or the total stock market can give you immediate diversification without overcomplicating the process. Now let's do a live example. Let's say you're brand new and you have $1,000 to start investing. On top of that, you can invest $300 every month. Instead of trying to time the market, you decide to invest right away into a broad market ETF. So month 1, you put in the full $1,000. Then every month after that, you add another $300 automatically. Now let's assume the market gives you an average annual return of 8% over the long term. That doesn't mean every year will be positive, some years will be down, some years will be flat, but over a long period, let's use 8% as a reasonable example. After 1 year, you would have contributed $4,600 total. But thanks to growth, your balance may already be a bit higher than what you put in. After 5 years, you would have contributed $19,000. But with compounding, that account could grow to well over that amount. After 10 years, you'd have invested $37,000 out of pocket. But if the market performed reasonably well, your actual portfolio could be significantly larger because your gains begin earning gains. That's the part most beginners underestimate. Your first few $1,000s feel slow. Your first year feels small. But investing is one of those games where the beginning looks unimpressive and the middle becomes powerful. Compounding rewards patience, not excitement. And this is why most people fail. Not because investing is too hard, but because they quit too early. They want results in 6 months. They check their app every day. They panic when the market drops. And they confuse temporary declines with permanent failure. Let me make this really clear. Market drops are normal. If your investments go down next week, that doesn't automatically mean you made a mistake. In fact, downturns are part of the process. If you're investing for the next 10, 20, or 30 years, short-term volatility is just noise. That doesn't mean risk disappears. It means you manage it through diversification, consistency, and time. Now, here are a few mistakes beginners should avoid. First, don't chase hype. If everyone is suddenly getting rich from some random stock or crypto coin, you're probably already late. Second, don't try to become an expert overnight. You do not need 17 investments, 4 trading apps, and a color-coded spreadsheet before you start. Third, don't wait for the perfect time. There is no perfect time. Most people use uncertainty as an excuse to stay in cash forever. And fourth, don't invest money you need for rent, bills, or emergencies. Investing is powerful, but it should come from stability, not desperation. If I were starting from zero today, I would focus on simplicity. I would build an emergency fund, open an investment account, automate monthly contributions, buy low-cost index funds, and then leave it alone long enough to work. That's it. No flashy tricks. No pretending to predict the market. No trying to double my money in a month. Just a simple system that I can follow whether the market is up, down, or sideways. Because in the long run, successful investing usually comes down to one thing: staying consistent long enough for the math to start working in your favor. So if you're a beginner, don't overthink this. Start small, start simple, start now. Your first investment does not need to be perfect. It just needs to happen. And years from now, you'll be glad you didn't wait. If I had to teach someone how to invest from absolute zero and I could only give them one video to watch, this would be it. Because beginner investing is not about finding the next big stock, becoming a day trader, or making money as fast as possible. It's about building a system that works even if you're busy, inexperienced, and not obsessed with finance. And honestly, that's exactly how it should be. A lot of people think investing is complicated because the financial world benefits from making it sound complicated. The more confusing it seems, the more people assume they need to hand over control to someone else. But the reality is, most beginners can build a strong investing plan with a few basic principles. So let's break it down. The first thing you need to understand is that investing is not step one. Step one is stability. If you're living paycheck to paycheck, carrying expensive debt, and have no emergency savings, then investing should not be your first priority. You can still learn about it, but your money needs a safety net first. Why? Because if you invest money and then need it back next week for an emergency, you could be forced to sell at the wrong time. That's why cash flow matters. Once your foundation is in place, the next question is, where should a beginner invest? For most people, the answer is simple. Start with diversified index funds, or ETFs. Why? Because they're low cost, easy to buy, and they spread your money across a large number of companies. Instead of trying to guess which stock will outperform, you're buying a slice of the market itself. That means your success doesn't depend on being a genius. It depends on staying invested. Now let's talk about the biggest beginner mistake: trying to be too clever. People often think if they just do enough research, they can beat the market. And maybe a few can, but most can't, especially consistently. The average beginner is much better off owning the market instead of trying to outsmart it. So here's the simple framework I'd use. First, open a brokerage account or retirement account with a trusted provider. Second, decide how much you can invest every month without putting yourself in financial danger. Third, automate it. Automation is one of the most underrated wealth-building tools in the world, because when investing becomes automatic, it stops being emotional. You don't need motivation every month. You don't need to guess when the market is safe. You just stay consistent. Now here's the live example. Let's say you're 25 years old and you can invest $200 a month. That may not sound like much. In fact, a lot of people would dismiss that amount completely, but that's a mistake. Let's also say you start with an initial $500 deposit into a broad market ETF. So right away, your account starts with $500. Then every month you add $200 automatically. Now assume an average annual return of 8%. After 1 year, you've invested $2,900 total. Nothing life-changing yet. After 5 years, you've invested $12,500 total. But now you start noticing something important. Your growth is no longer only coming from your deposits, it's also coming from compounding. After 10 years, you've contributed $24,500. But your portfolio could be worth much more than that depending on market performance. After 20 years, this starts becoming really interesting. You didn't suddenly become rich overnight. You built wealth slowly, quietly, and predictably. That's what investing looks like in real life. Not flashy, not dramatic, just effective. And here's the secret most people miss. Investing small amounts consistently beats waiting around for the right moment to invest a large amount. The perfect time usually never comes. Now, what should you actually buy? For a beginner, keeping it simple is usually the best move. One broad US stock market ETF, one S&P 500 ETF, or even a global index fund can be enough to get started. As you learn more, you can expand later. But in the beginning, complexity is not your friend. If you add too many funds too early, you can create confusion without adding real value. You also need to understand risk. When you invest in stocks, your account will go up and down. That's normal. If you can't handle seeing your portfolio temporarily drop, then you may be investing money you need too soon, or you may not fully understand the time horizon. A beginner should never invest with a one-month mindset. If you're investing, think in years, preferably decades. That time horizon changes everything, because once you zoom out, temporary drops become much less scary. In fact, when you're regularly investing every month, lower prices can actually help you because you're buying more shares for the same amount of money. That's one reason why panic selling is so damaging. People sell low because they feel fear, then buy back later at higher prices because they feel safe again. That's backward. The market rewards discipline more than intelligence. Now let's cover a few beginner rules I personally think matter matter a lot. Rule number 1, fees matter. If you're paying high fees every year, that quietly eats into your returns over time. Low-cost funds are your friend. Rule number 2, ignore short-term noise. News headlines are designed to trigger emotions, not build wealth. Rule number 3, don't compare your beginning to someone else's middle. Social media will make it seem like everyone is getting rich overnight. Most of that is either luck, exaggeration, or risk you don't see. Rule number 4, keep learning, but don't let learning become procrastination. You do not need to consume 500 hours of finance content before opening your first account. If I were a beginner today, I would keep it incredibly simple. I'd save a small emergency fund, pay off bad debt, open an account, buy low-cost diversified funds, automate contributions, and commit to doing that for years. That's it. Because successful investing doesn't come from chasing excitement. It comes from building a repeatable process and sticking to it when it feels boring. And yes, boring works. So if you're new to investing, stop waiting to feel fully ready. Nobody feels fully ready in the beginning. Start with what you have. Start with what you understand. And most importantly, start before another year passes while you're still thinking about it. Because the best investing strategy for beginners is usually the one that is simple enough to follow and strong enough to keep going. Let's say you finally decided you want to start investing, but every time you look into it, you get hit with the same problem. Too many options, too much jargon, and too many people acting like this is way more complicated than it really needs to be. So in this video, I want to walk you through a beginner-friendly investing strategy from start to finish, including a real example. So by the end of this, you'll know exactly what to do, what to avoid, and how to keep it simple. Because honestly, the best beginner investing plan is usually the one you can actually stick to. Let's start with the mindset. A lot of people think investing is about making fast money. It's not. Investing is about owning assets that grow over time. That means you're not just working for money, your money is starting to work for you. And if that sounds slow, that's because it is. But slow is good. Slow is sustainable. Slow is repeatable. Slow is how most real wealth gets built. Now, before you invest, ask yourself one question. When will I need this money back? If the answer is next month, 6 months from now, or even within a couple of years, then that money probably shouldn't be in the stock market. Investing works best with a long time horizon. The longer you can stay invested, the more time compounding has to do the heavy lifting. That's why a beginner should think less about how much can I make this week and more about how do I build a system I can maintain for the next 10 years. Now, here's the simple formula. You need an account, a contribution plan, and a basic investment choice. First, the account. If your country offers tax-advantaged retirement accounts, learn those first. If not, a standard brokerage account works too. What matters most in the beginning is that you choose a reputable platform with low fees and easy access to diversified funds. Second, the contribution plan. Decide on a number you can realistically invest every month. Not your best month, not your fantasy month, your actual month. If that number is $100, great. If it's $500, even better. But consistency beats intensity. Third, the investment itself. This is where beginners often get overwhelmed, but it doesn't have to be. A single low-cost diversified ETF can be enough to get started. That one decision alone can give you exposure to a large part of the market without forcing you to pick winners and losers. Now let's make this practical with a live example. Imagine you're starting with $2,000. You've already built a small emergency fund, you don't have high-interest credit card debt, and you can invest $400 a month going forward. Instead of trying to wait for a market crash, you decide to get in now and stay consistent. So on day one, you invest the full $2,000 into a broad market index fund. Then every month, you automatically add $400. Let's assume an average annual return of 8% for the sake of the example. Again, that doesn't mean the market moves in a straight line. Some months will be ugly, some years will be fantastic, but over long periods, this gives us a useful framework. After 1 year, you've contributed $6,800 total. After 3 years, you've put in $16,400. After 5 years, you've contributed $26,000. But here's where it gets interesting. The account value is no longer just about what you deposited. It begins reflecting market growth on top of your contributions and then growth on top of that growth. That's compounding. And compounding is the reason why investing looks boring at first and impressive later. It's also why starting earlier matters so much more than starting bigger. A person who starts small at 22 can often end up far ahead of someone who starts large at 35, simply because time matters more than most people realize. Now let's talk about what not to do. Do not wait until you know everything. You never will. Do not let fear of a market drop stop you from getting started. Do not try to build a portfolio so complicated that you need a spreadsheet and 3 energy drinks just to understand what you own. And definitely do not confuse social media investing content with actual investing discipline. The internet rewards excitement. Wealth usually rewards patience. Another thing beginners need to understand is that volatility is normal. If your $2,000 becomes $1,850 after a rough week, that doesn't automatically automatically mean you failed. It means markets move. If your time horizon is long, short-term drops are part of the ride. In fact, when you keep investing through those drops, you may actually benefit because you're buying assets at lower prices. This is one of the biggest mental shifts in investing. When you're new, market drops feel like danger. When you become more experienced, market drops often look like temporary discounts. Of course, that only works if you're diversified and investing responsibly. If you throw all your money into one speculative stock and it crashes, that's not the same thing. That's why diversification is so important. Beginner investing should focus on reducing unnecessary risk, not increasing excitement. Now, if you want a simple routine, here's what it might look like. Every payday, a fixed amount automatically transfers into your investment account. That money buys the same low-cost diversified fund every single month. You check the account occasionally, but not obsessively. You ignore the daily noise, and you keep doing this for years. That's the strategy. It's almost disappointingly simple, which is exactly why people overlook it. They want something more advanced, more impressive, more insider. But most of the time, the simple strategy wins because it actually gets followed. If I were helping a beginner start today, I'd say this. Don't try to become a market wizard. Become consistent, learn the basics, respect risk, use broad diversification, keep fees low, stay invested, and give yourself enough time for the results to show up. Because investing is not about being perfect, it's about being persistent. So if you've been waiting for the perfect moment, the perfect strategy, or the perfect amount of money to begin, this is your reminder that you do not need perfection to start building wealth. You just need a plan. And once you have that plan, the next step is simple. Start.